Morning, currency traders. How you doing? Hey, it's a Monday, so I suggest we go through the calendar, check out all the event risk that we have this week, then do technical analysis on gold, on oil, on dollar pairs, on yen pairs, some Swissy pairs, and whatever pair you want me to review. Let's go. So let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. But please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. So good morning. Hi, my name is Wayne. I'm a currency trader. I've been doing this for a very long time, and I'm here to help you gain the experience you need to find success in this business called Forex. I love it! So I think you'll find that this is better than anything else you've ever seen, but the thing is you're going to have to fight harder than you've ever fought. Actually, that's not true. There's lots of people in the currency world that have had to overcome much more difficult obstacles than learning how to trade Forex. So anyways, it is worth a fight. So cool. So I'm with Traders Way, and we're hoping that by providing this service to you every single day and helping you educate yourself and get the skills you need to find success, then when you do find that success, that you'll choose Traders Way as your prime broker for your successful Forex trading business, out of loyalty and respect and for paying it back, but also because of world-class customer service, fast execution speed, amazing swaps, competitive spreads. Sounds like a symbiotic partnership to me. So anyways, get involved. Make sure you leave comments on the video. Make sure you ask questions in the chat. Make sure you treat everyone else in the chat with dignity and respect that they deserve. This is a professional environment. Anything else? Oh, you can download my chart templates for free. That's about to change, though, so you better hurry up. And I think that's it. I think we're good. I think we're golden, right? Brooke says the video is breaking again. It shouldn't be. Okay, cool. So let's move on.com. Cool. So anyway, so visit tradersway.com. Here we are on Forex.Today. Hang on, maybe I should do it this way. So I always like to adjust the impact, get rid of medium, and just really focus on this. Of course, you can go through this whenever you want in the granular detail that you need. This is just a quick overview of the most important risk events of the week. There's the link. Thank you, everybody. And also thank you very much for the dozens and dozens and dozens of really positive, warm felt comments that you left on Friday's video. Very cool. Very cool. I read them all, and I really appreciate that positive feedback. Thank you very much. Namaste. Okay, going through the calendar. RBA meeting, whoop, whoop, whoop. It's coming up in today's Asia session. Even if it doesn't move the market, it probably will, but you should read them. Put that on your to-do list. Even if you don't trade it the minute it comes out, in the next 24 hours, read the RBA meeting minutes. GDP out of Norway, I don't know if you trade that. Keep an eye on it though, right? Canadian CPI, you think that'll have an impact on the Canadian dollar? Faux show. And then later on in the day, we have a couple of interesting ones. The FOMC meeting minutes, so now you're going to have to download and read those. But the Jackson Hole Symposium. Now, Jackson Hole used to be an academic-only central banker kind of meeting out in the beautiful mountains. And what year would it have been? I guess 2010. Bernanke made an announcement there. And up to that point, there really wasn't any press conference. Nobody really cared about Jackson Hole. But then he came out and I think it was Operation Twist or something that he announced there. And ever since that official announcement was made at Jackson Hole, now there's a horde of reporters going to visit Jackson Hole. And typically still nothing happens. But now it's weird though, because I remember Janet Yellen was having, let's say, discussions with another board member, one of the older ones, Bullard maybe, James Bullard. Anyways, they're contentious discussions anyways, and people were making light of this. And so at Jackson Hole, there was this real fake, totally set up moment where she and Bullard were standing there together, shoulder to shoulder, staring at the beauty of the Grand Tetons, and the 200 cameras behind them caught the moment, right? But you're like, oh wait, that's totally set up. But that suddenly that happens where even the central bankers are thinking about the media being there. So it's who knows what's going to happen. And of course, our current Jay Powell, he's probably going to make a stink out of it and do something stupid. So anyways, I think that's going to be a real risk. Well, it'll be overshadowed for sure, Chuck. But if you want to be a real currency trader, you'll read the meeting minutes and maybe watch Jackson Hole, and maybe something stupid will come out of Jackson Hole and, at least on the short run, move the market. But you'll always have the meeting minutes, and that's the work, the real work. You know what I mean? Not the dog and pony show, but whatever. They both will move the market most likely. One probably shorter term, one longer term. Unless Jay Powell comes out and says, yeah, we're no more interest rate cuts at all, and sticks his foot in his mouth, which, hey, is a real potential risk. Then, whoa, right? You know what I mean? Like, whoa, that could be something. So if you've never heard of Jackson Hole, that's totally cool. But keep an eye on it. This could be the most important thing that happens between now and the end of the year. You never know. So if he says, yeah, we're not going to cut interest rates more, wow. Okay. Because think of it this way: why is there a bond market rally? Why did the 210 invert? Because the economic conditions changed. And this is the part that the media doesn't understand. So you've probably been reading about the inverted yield curves and that means recession is imminent, right? Well, in this case, what actually inverted the yield? What made the yield curve invert between the 2 and the 10 and some of the others? Well, when the Fed tells you they're going to start buying up bonds and driving up bond prices and driving down yields, well, then everyone and his grandma starts front running the market. What if you knew right now the dollar was going to be weak from now to the end of the year? You start selling it. So the Fed created that. It wasn't the other way around. It's not like the yield curve inverted, then the Fed came in and cut interest rates. No, it was the other way around. And so, it's engineered, so to speak, not from the market, but from the monetary policy. Okay, so whatever. So anyways, that's what's happened. So if suddenly we find out that maybe that policy isn't true, guess what happens to all those bondholders? And imagine, though, too, that not the people that have been buying bonds for the last 10 years, but what about the people that have been buying bonds just now, starting over the last 10 weeks? Imagine they're all leveraged 40 to 1. Like, the real cash holders are not leveraged at all. They actually bought bonds. They're not speculators per se. They're buying an attractive yield because they face a risk over a certain period of time, right? But then others are like, right, the Fed is buying, the Fed is buying, the Fed is buying. So they go in and they load up on leverage, and then they start front running the Fed. So what happens if suddenly Jay Powell comes out and says something stupid at Jackson Hole, and it's interpreted that they're not going to buy as many bonds as everybody thought? What happens to the top end of that, that buying, right? They're all out leverage, so it comes down as fast as it went up. Now, I don't really expect that, but think about, like, what is the mechanism that has occurred to create these situations? And of course, you don't hear that on TV. You don't hear that in the newspapers. You probably don't hear that anywhere else. But you have to think about, like, what is actually happening. Okay, and what's actually happening? Think about it on a more logical. So let's not talk about this leveraged speculators, but what about, like, insurance companies and stuff, right? And the Fed announces that they're going to lower interest rates. So you're like, well, we better lock in a higher interest rate now, right? That's all. So, like, okay, so what can we pick up here? Oh, you can pick up 1.8. Well, cool, because it'll probably be 0.8 in a year. So yeah, we'll pick up the 1.8. So you just lock that in, that current rate, knowing that rates are likely to go down. So you just lock in that rate. And then if it's true, if a year from now the bond yields are 0.8, not 1.8, guess what? If you wanted to liquidate, so liquidity is important, right? If you wanted to get rid of your bond, do you think you can find a buyer for your bond that pays double the market rate? Hell yeah, more than double. Yeah, so you think someone would be willing to buy that? Yeah, at a premium. So, like, that's all that's happening. Pierre, try to think it out, pure mathematics. You're at the Forex.Today YouTube channel. Come on, brother. Use that gray matter. Click, click, click. You'll probably figure out the answer to that question. All right. So we're using the Forex.Today calendar. Right. Right. There you go. Now you got it. Hey, no worries, man. All right. Euro PMI. Great. Okay. And then check this one. What? EZB minutes? More Jackson Hole, more Jackson Hole. Okay. CAD retail sales great for Friday. Mixes it up, keeps the markets moving. European PMI, look, they're below 50 on the manufacturing. Like, it's just disastrous. It's like, hey, let's check in on the Titanic now. More water. How's it going, Captain? Could you pass the life vest, please? So yeah, they're drowning here. So anyways, meeting minutes. Great. Good, right? Good. It's all about the meeting minutes. And then keep your eye on, like, I don't remember what day the press actually comes in and follows these guys around outside as they mingle. So it's that day that Jay Powell, being a businessman, is likely going to take advantage of the spotlight. Like, think about it. Normally, these Fed people, they're nerds. And I say that affectionately. They're nerds. They should be nerds. They have PhDs in economics. Okay? And they've spent their whole life as civil servants. They're not interested in yellow Lamborghinis and purple suits and $10,000 cufflinks. There's no models and bottles at the Fed. So when it comes to like, hey nerds, who wants to go on TV and talk to all the press? And like nobody wants to do it. So all of a sudden here comes Jay Powell, straight out of the country club, right? Businessman. And he's like, oh, we should leverage this somehow. Yeah, we should leverage this. What should we do? You know, what can we do to get the press all excited about our policies? Like, dude, nobody's excited about your policies. But anyway, so you see how he could go in? And all the Fed people are like, oh, that jock is going to go up there and say something stupid, isn't he? Yep. Blessed morning to you, Carly. So anyways, that's it. You know, one of these things, so someone said, who said it? I have to scroll back. Craig, I guess. The world's going to hell in a handbasket and all that. You know, I don't think anything. Here's what I think. We do our work, our research, right? We do our research, both technically and fundamentally. And then we set up a hypothesis, measure market conditions using technical analysis, and set up trades. I don't care if things are awesome or horrific. There's just a trade. You know, some of the best, most ridiculously awesome trades have been during the most horrific moments of time. And when your neighbor was losing 50% of his net worth, my net worth was going up 50%. It was crazy. It was crazy. It was just crazy. So it doesn't matter to me. It doesn't matter. That's one beautiful thing about Forex. When it's going up, you're buying. When it's going down, you're selling. Now, everyone else around you will either be cheering because they're in a bubble, or they're going to be crying because it burst, and they're running around freaking out, and you're just sitting there doing your job and making money. And that's truly, really, truly an amazing part of this opportunity in front of you. It's really, really, really crazy how awesome this is. Right? Amazing. Absolutely amazing. So there's the week. It's pretty good, you know, because you need some news flow to keep sort of the skids greased, so to speak. You know, some CAD retail sales, great on Friday. That's nice. It's just enough. European PMI, it can't be possibly good. I mean, maybe it's less bad than everyone thinks, and that moves the market a little bit, but that's cool. But it's hard. No, it's not. It takes effort. It takes some sacrifice and stuff. But like, dude, there are so much more difficult things than Forex. It's not impossibly difficult. You don't need a PhD. You don't need to be brilliant. I refute all of that. You do have to be a hard worker, though. If you're lazy and you think you're going to get rich quick, right? By the way, you don't get rich quick. That's like, it's such a fool's game to even think that way. But if you're willing to put in the time and the effort and the hard work, oh my God, this is for you, man. This is totally for you. All right, so we got to get going. Let's get off the fundies here, or the risk events. Okay. So I spent a lot of time with my family over the weekend, swimming. We went to parties with our friends and stuff like that. But I also worked on Forex stuff for, I'd say, at least 10 hours this weekend, on top of being a pretty decent dad and a pretty decent husband and all that kind of stuff, and a pretty decent friend. Getting in all of that, right? I got up early at 7:30 in the morning on Saturday, made coffee for my wife so it would be ready when she was up. And she gets up fairly early. So coffee was ready when she came down, and spent some time with her. And then I said, I'm going to be busy for several hours. I'm going to go down to the office and work. So, like, is Forex hard? Well, when it's said that the way it was said, when it's said the way it's said, it felt to me, it was like, you know what? Not many people succeed because it's so hard. You have to be born with some innate ability, or you have to have that Harvard economics degree, or a combination of both. You know, it's only for the chosen few, the Illuminati, and that's bullshit. All right. So what it is there you need some knowledge and some skill. It's all there. You can learn it in a year or two. It's not a 4-year, 10-year, 20-year degree or something. You can learn it, but it does take tenacity and hard work and effort, lots and lots and lots of effort. But it's not inaccessibly difficult. So just don't even say things like that. And that's why I jump on when people say things like that, I jump on it, because there's someone else thinking, yeah, pure mathematics is right. This is too hard for me. You know what? I refute that. But you better put in the effort. If you think you're going to get rich quick and easy, dude, you're such a dreamer. It ain't going to happen. If you think you're going to sign up for some online training to learn how to be a pianist, and then you're going to be ready to play in concerts, what, in 6 months, and you're not even going to practice? I mean, get out of here. How many hours a day do you think a concert pianist practices? How many hours a day do you think a professional golfer making millions of dollars a year practices? Right? I want to be like Phil Mickelson. He flies around in a private jet. He's so rich, and he's in commercials, and he's so famous, and he goes to the parties. Yeah, but he also works, 15 hours a day his entire life. And like I've told you before, I know of some very filthy, stinking rich people, but they're all hard workers. All of them. All the time. All the time. I don't know any lazy millionaires or billionaires. Well, there's probably a few lazy millionaires. They flip some real estate or something, but I don't know any lazy billionaires. I really don't. So anyways, let's move on.com. I got to get my drawing tool. Oops. I got to get my drawing tool here. You can email me at wayne@fxbootcamp.com, but I often don't respond just because I can't keep up with the email I get. And so I apologize for that now. Okay. My mother and father don't email me, so don't take it personally. All right. But try, and I'll do my best. Julia, go jump off a bridge. Go spam someone else. Goodbye. A loser. Wow, dude. What a loser. All right. All right. Boom, 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 boom. What do we want to do here? Well, this is peso. And we're just entering the third week here. So by the end of the month, August, July 3rd. So there's only 30 days in August. So by, let's say, the 1st of September, we're going to want to see this. But I don't want to do anything now. But if you did, now can you think of any reason why you might want to short USD Mexican peso? That's interesting, Chuck Duck. When Tiger was at his peak, Mickelson was asked if he could be as good as Tiger, and he said he didn't want to be because that work, it would take him away from his family. Yeah, you'd have to work so hard. Yeah. Okay. So. Because if you can stay short all year, you're going to make 900%. So that would be one reason why. Is it plausible over the next 6 months the US dollar gets weaker? It's plausible, right? But it really comes down to how the market plays this. So right now it feels like the dollar is getting strong, and I believe it's mostly foreign buyers buying those bonds. Remember, we're in a bond rally. Okay, we're in a bond rally. So if we can stem that flow, okay, then you'll get this way. But like you should know, traditionally in a global slowdown, the Fed, if the U.S. is affected, cuts interest rates, and the dollar strengthens, even though interest rates are being cut. And you'll read in textbooks that when interest rates are cut, the value of the currency is supposed to fall. In this case, the dollar very often strengthens. But what I've been trying to do over the last, let's say, year or so, is make a dichotomy of the thing where you got sort of the world, and then you got the U.S., otherwise known as us. Try to separate the two, because typically when the Fed cuts interest rates, what else is happening? Jobs are falling. What else? And prices. So we'll call that inflation. And prices are falling. So the Fed follows by cutting interest rates. More jobs are lost. Inflation falls further. Fed cuts interest rates. Jobs start to stabilize. Inflation starts to stabilize. Fed might cut one more time and then stabilize, because they want to overshoot a little bit so that jobs start going back up, and maybe at some point inflation starts, but inflation's a big lag. Okay, so this is interesting, where jobs are not falling, inflation's not falling, but the Fed is cutting interest rates. I really struggle to think of an example where something similar has happened. So what I was thinking over the last year or so, that if the Fed cut interest rates in this scenario, that the dollar, in this case, would weaken. But it looks like the global part, the world, is hurt so much that they're the ones buying U.S. treasuries despite the fact that interest rates are falling. They still want it. And the Fed might have been worried about the carry trade, so to speak, meaning the high interest rates in the United States relative to the rest of the world. because then that drives the dollar up. And what does an expensive dollar do to inflation? Right, the Exiles 100 says U.S. is the only place left with any yield. Right, so that is why the Fed is cutting. But why? Well, because if the dollar's strong, inflation falls. But what is every central bank in the world trying to do? They're trying to create inflation. So you don't want a strong currency. So China has a weak currency. Australia has a weak currency. New Zealand's got a weak currency. Canada's got a weak currency. Right? The pound, the British have a weak currency. So on and so forth. What are the strong currencies? Swissy, yen, and dollar. And these are important currencies and have unique characteristics of them out. So you may have heard me over the years describe myself as a macro trend trader. What does that mean? Oh, that was supposed to be macro trend is supposed to be in there, sorry. Trend. So what does that mean? I use macroeconomics to decide whether global GDP is expanding or contracting. With that simple knowledge, if the market is expanding, the global market is expanding, I typically sell these three currencies. If the global economy is contracting, I'm buying these. So there's an inverse relationship. And then, of course, I'm looking for trends and trading with that trend based on fundamentals. That's what I do. Okay. So right now, what seems to be happening is foreign investors are, and I suppose even some domestic investors, as interest rates on the 10-year drop from 1.8 to 1.5 to 1.2 to 1.0 and maybe even beyond, 1.8, 1.5 or 0.5, right? As this move is happening, investors are kind of trying to lock this up. And now this is gone. So they're trying to lock this up. But most likely, when the Fed cuts interest rates one more time, bond prices will rally, bond yields will fall, and this will be gone. And it may be a year or two or 5, or maybe a decade to catch a 10-year at 1.5. So they're buying it on the way down, but then once we stabilize, that's over. Okay. But the question is, couldn't I also buy, a real estate investment trust listed on, where do they list? Where do REITs list? Is it S&P or is it NASDAQ? It's NASDAQ, isn't it? So you can go to the NASDAQ, right? The National Association of Securities Dealer Electronic something. So you go there and you can buy that, and you collect payments from your REIT based on the amount of rent their investments have made, right? And you could probably collect, 3%? 5%? Just in dividends. Seems to me I would buy that instead of bonds, but that would be logical, wouldn't it? So what's happening here is it's more emotional, and it's also foreign investors, I think, because that's why the dollar would get strong. If it's foreign investors, the dollar gets strong. If American investors are driving down yields because they're front running what the Fed's told them to do, I mean, they're literally doing what the Fed asked them to do. Because when the Fed says, yeah, we're going to keep cutting interest rates, what are they saying? We want you to lower interest rates for us by front running us. That's why they tell you. Okay? Remember, the ECB bailed out Greece and they didn't spend €1 of their own money. Beautiful. And are you okay? Are you okay? Yeah, we're good. 1 minute covers. How are you doing? So anyways, they lock in as it falls. But let's say we get down to 1.0 on the 10-year and it stabilizes and stuff. Everyone's got what they needed, and off we go again. Because we're still at full employment and slightly rising inflation, slightly rising wages, a very robust domestic economy. Okay, so very interesting stuff. So one day, maybe not even this year. One day, but maybe not this year, we'll be selling the dollar. So we have to pay attention to all that, put that into our cap. But is there another way to play the, let's say, how do you play, if you thought, so this is a stretch now if I phrase it this way, if you thought the global economy is stabilizing, I bet you a lot of people wouldn't know. How do you play like the U.S. economy maybe? That's not even good. Is there any hope? Is there any hope that things are not as bad? That the U.S. bond market rally, and I'm telling you it's a significant rally, but is there any hope that that is an isolated event, maybe something created by the Fed and some exogenous factors like, yeah, a lot of economies around the world are slowing down, but that's all sort of predictable and priced in, and like it's not new news, right? We've been doing this for 10 years now, actually more than 10 years. So is there any plausibility that this is an isolated thing, possibly to do with the stance of the Fed? And if so, what kind of currency trade can we make to decide maybe the global macroeconomic stuff isn't as bad as it seems, and maybe this bond rally is simply a bond rally because bond traders were told to buy bonds because the Fed were going to buy bonds and drive up bond prices even further, and that they're going to make all the bond dealers filthy, stinking rich. Because remember, the Fed works directly with the 12 dealers in New York City, so those bankers are going to get filthy, stinking rich if they only do what the Fed says, and the Fed says, yeah, we're going to drive up bond prices, so why don't you front run us by buying a bunch of bonds, and then we'll buy those bonds from you at a higher price. Did you know that that's what's happening? Maybe you haven't even thought of that. You're like, really? Is that what's going on? Yeah, so anyways, what could we do, guys, to see if there's a separation, like I said, a dichotomy about what's happening around the world, which we can say what's going on with the bond market in the U.S., and versus what's happening in the actual sort of economy. And the answer I'm looking for, because I have a feeling I'm not going to get an answer, are yen pairs. Now, if the bond rally is simply a bond rally and not a reflection, not a canary in a coal mine, it's just a canary, then if things are not terrible around the world, what direction will these yens be going? Pure mathematics is progressive taxation. You know, I wrote a paper on that. It's interesting. It ends up not working, but anyways. Yeah, up and up and up. That's right, up. Okay, so we can take a look at, oops, didn't mean to do that, and it's gone. All right, I'll have to set that later. All right, let's look at this. Aussie. So I went long, 3 days ago? Cool. Not higher than a highest high yet. So this week's going to be important because we'll probably do something like this. And to breach this level here is going to be the monster move, right? If we get through that, Joey says, this is amazing fundamental insight. Very high IQ. Thank you. Let me tell you, I'm probably the dumbest guy at Harvard, but I made it through. All right. So, cool, right? We got a lot to go. Like, there's no need to sort of jump up and, you know, like I say in my book, high five my cat and ring a bell. But it's something, right? And it's an opportunity, and I can't lose money. And you can see what I did. You don't have to be a rocket surgeon. You can see what I did. Very cool. Right on. Okay. Right on. Okay. So I'm just saying, I hope it keeps going. And if we get above here, that would be technically important information. Yeah, a fake out could be interesting here, but you can see that it's leading toward an apex, if you will. So I was trying to think about how to draw it. Okay, you would draw it like this. Okay, and we're calling this a triangle. Okay, cool. So with the triangle, the closer you go, the closer you get to an apex, which is the pointy thing here, the closer you get to the apex, the more you can trust the breakout. Okay, so like moves like this are rare. They're rare. So that's why, right? That's why I was saying a fool and his money will be departed, right? Quickly departed. Where you wait for this giant move, and then you see this giant green candle after 8 hours of rallying, and then you decide to buy it at resistance, right? I mean, how foolish is that? So the trick, if you're patient and disciplined, if you have patience and you're disciplined, is to wait for a pullback. So I had measured, this was like a 50% here. 618 was just above here, but then I looked at this and I did that. And so you're like, well, really, we need a pullback to here down into the support level. And there's a 618 and just slightly like 7.0, and then maybe around there I should be buying. But the thing is, that thought process occurred here. That I'd have to wait a day or two to buy it down here. But if I did, I'd be buying low at support, and it might work out. Now, the next thing is, you know, if it did this, it's probably too fast, and it'll probably pull back because the market's not quite ready for that move, especially in the summer, right? So if we can slowly, okay, if we can slowly oops. If we can slowly kind of work our way up and a little work our way down, work our way up, and maybe Tuesday or Wednesday work our way through. Actually, I should even redraw that. Probably look more like, you know, up and down and up and down and up. That's best. Slow and steady, steady and slow. Okay. So that's the plan, but to me, I have no emotion attached to this. I don't have any risk associated with this trade. I'm collecting yield, not much, but I'm collecting yield. Yeah, news might come out tomorrow, or it's actually tomorrow in Asia. For me, it's tonight. But yeah, it could be less bad, and all of a sudden I'm kicking. Cool, right on. And they'll say, yeah, well. Or it drops me and knocks me out of break even, and I say, oh, well, you know, I had an opportunity, a free shot. And then I think it was Friday I did this one. So I did one on Wednesday, one on Friday. Here's the Friday one for CAD. Stops at break even, right? Up, 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 down, down, buy. Up, 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 down, down, buy. Up, 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 down, down, buy. Right? Up, 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 down, down, buy. Up, 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 down, down, buy. Up, 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 down, down. Right? Roll reversal. Buy. And it might be all right. Might be all right. Just moving along. So those two trades now, I think last week combined were just about 200 pips. Not quite. 170 pips or something. Cool. Yeah, and Prince Philip says, yeah, I just answered my question. What? Well, the real answer is it's really up to you. I don't know how much time you spend in front of your chart. So like a swing trader might just buy here and walk away. What'd you do this month? Oh, I bought CAD yen. What'd you do this week? Oh, I bought CAD yen. Right? Like, do you have to be a rocket surgeon to buy at the central pivot if you're already a bull? No. And if you bought it here, right? Are you comfortable with that? Yeah. So what did you do this month? Bought CAD yen. Oh, what did you do this week? Oh, bought CAD yen. That's what a swing trader does, right? Now, if you're a day trader, you probably got this, and then you probably got this, and you probably got this, but this is also a weekly swing, right? And tomorrow you'll probably get something like this, and you're doing day trades. Then inside of that, you got intraday trades, right? So these are 15-minute charts. So you'll notice about every 3 or 4 hours, there's a trade. You notice they're all the same. Up, 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 down, down, buy. Up, 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 down, down, buy, right? Just every 3 or 4 hours, you just... Well, what happens every 3 or 4 hours? Well, you have the Asian session. Then you have the London session. Oops, I didn't draw this very well. Hang on. Let's do it this way. You have the Asian session, you have the London session, and then you have the New York session, right? And typically for me, this could be like, we'll say 6 to 10, and then this is 2 in the morning to 6 in the morning, right? And then this is 8 to 12. There's your day. So this is 6 to 10 p.m., a.m., a.m. That's a full day. So you could be trading inside of those or part of those. So when I do intraday trading, I call it spot trading. So when I do spot trading, I'm asking myself, you know, what's the yen going to do in the London session? And I'm only trying to make 25 to 50 pips. If I'm day trading, I'm like, what's going to happen today? If I'm doing a weekly swing, right? So I'm swing trading, I'll say, what's happening this week and really the course of this month? And then carry trading is a lot like it's monthly swing trading. So first of all, it uses a monthly swing strategy, but then I'm paying attention to the interest rate differentials in yield. So I'm trying to do that on purpose. And the interesting thing about carry trade is you're not really trying to make money, right? So like that peso trade that we were looking at earlier, if you're truly doing a carry trade, you're looking at hardcore resistance. So let's call that hardcore resistance. And you're interested in getting short. You're not interested in getting long. So you know that for a fact. So now your thought, not on a 4-hour, but maybe now on a 15-minute chart, is if you were able to buy a little dip here, right? Let's say you risk 50 pips or something really small. And after a day, you can move that stop to break even. That's all you care about. So what if it comes back and knocks you out? But the idea is, how many days can you be open? So if you can be open short 365 days, okay? And you invest $100 in your cash from your account, which is leveraged 100 to 1, at the end of 365 days, you will have collected a swap of $900. We haven't even calculated pips. This is not pips. Your $100, due to the magic of collecting a high yield on your leveraged money, you've collected $900 in swap, plus you get your $100 back when you cash out of your trade. So you made 900% if you were right. Now maybe just maybe you get pips on top of that, and you probably make I'll say 9,000 in pips plus $900 in yield on a $100 investment that you held for 365 days. That's the goal. But what if it's only 65 days? Well, you get 65 you get 10% of it. Whatever. You have to think of it as you get paid 900% a year yield, like a bond. That's the amount that you get paid. And it comes down to how long do you hold that investment? A day? Well, then you get 1/365th of that. Or you could get 65 365ths of 900%. But at the end of the day, if you said to someone at a cocktail party over the weekend, they're like, hey, how's trading going? You're like, I made this really great investment. It pays me 900% a year in interest payments alone. But the asset itself has great potential for appreciation. Mayor, I don't understand your question. $100 investment means risk taking? I don't understand the question. Yeah, I mean $1 is risk. Okay. So think of it this way, guys. You invest $2 million into an apartment building, but you only needed $200,000 in cash. And the rent over the course of the year, minus your expenses, is going to pay you, well, in that case, this ain't going to work out, right? $1.8 million. So, that's why, because you're not leveraged really truly 100 to 1, but that's only 10 to 1. So, like, all of a sudden, Forex is so great, you couldn't even come close to doing this in real estate, because really, you're only leveraged 40 to 1, I think, in real estate maximum. That's not even right. Is it 40 to 1 or 4 to 1? In real estate, well, what do people typically do? They put 20% down, right? So in $1 million house, you need 200,000, but I think you need more than that. So you're going to need 300,000 if it's commercial on $1 million. Yeah, it's not much, because then you're only borrowing 700,000. You put 300,000 down. Gee, yeah, it's like, yeah, it's 3 to 1, not 100 to 1. So you see how like crazy all of this gets? But it's like if you were to translate it, and I think even this math is wrong. You put in 200,000 to get an apartment building that pays you 1.8 million per year, plus the value of the apartment building could double over the course of 10 years, right? But all of a sudden you're like, dude, this would have to be like a $40 million property to make all this work out mathematically, like whatever. It's so much better. It's so much better than anything else you've seen. But the funny thing is, right? The funny thing is, most people that come into Forex, they don't think this way. They don't know they should think this way. They want to make some quick pips. Look, I traded the CPI news and I made 27 pips, right? Right? You're like, really? Good for you, bro. You made 27 pips. You should go out and buy yourself a latte, right? And there's such a bigger way of thinking where you're like, do you understand? I own an asset. So, like, let's go back to the lira one. There's a great one. Let me turn that off. All right, so the lira, okay, I've owned since May. So all of May, all of June, all of July, and half of August. So for less than 4 months, 3.5 months, about 1,000 days, right? Or sorry, about 100 days. I have $100 invested, and I've collected $306 in swap. I've made 300% in 100 days. I've made 300% on my $100. Plus, I'm up 1,400% in pips. So on this pissy little trade, I'm up 1,700%. Right? Like, hey, that ain't bad. So by the end of the year, oh my God. Well, we don't know how many pips I'll be up. I might make nothing on pips. But we know at the end of the year, my $300 will then turn to $600, which will then turn to $1,200 in swap. But that's only $300. So then half of that, right, is $150, right? So 3 to 6, 6 to 9, 9 to 12 plus $150. So, right? In swap, I'll have about $1,400 at the end of 1 year. So in May 2020, in swap collection will be $1,400 in swap. And I only have $100 invested of cash, leveraged 100 to 1. So thank you, Traders Way. You will be hard pressed. You may not actually be able to find a better swap than that. But thank you, Traders Way. Thank you very much. Now think of that. Now think about what if the trade continues to make pips? Because remember, I'm up 300 in pips, but I'm up 1,400% in pips. Right? So now this could really work for me, right? So you're like, you know, I just hate to make less than 2,000% return on investment on a trade. Wouldn't it be funny to say that to one of your buddies? You're like, yeah, I just can't bear taking profit with less than 2,000% return on investment. Otherwise, I feel like a pathetic fool. But anyways, food for thought, right? Food for thought. What do you stink? Smell like a plan? So that's why we're talking about this one with the peso. Like, I understand this is a dog with fleas. This trade sucks. This is definitely not falling. But over the course of time, if you got to be really good at being a cheeky little monkey, where every once in a while you throw a little scalp down on a small time frame because you see it rolling over at very obvious resistance. It's not a good trade, but it's not a pathetic trade either. And you're able to just jam your stop and take a walk. You know what? 20, 30% of them you'll catch. And you're telling yourself, well, I probably won't make any pips, but I'll collect, 4 days of interest. It won't be much money, but you understand that 4 days at 900% a year, the more you do it, the more of the year you collect. And at the end of the year, you're like, you know what? You got 182 days on this USD Mexican peso where you had a trade open at rollover. Now, here's another thing, and this might blow your mind too. What if you sold this? Oops, I'm trying to clear this. Boom. What if you sold USD Mexican peso at 4:59 p.m. At 5 o'clock, you collect 1 day's yield. 1 day. 1/365th of the 900%. So that at 5:00 point, so 5 seconds later, you close the trade at break even. You get 1 day's one full day of interest rate payments. Now, how about this? What if it's Wednesday? At 4:59, you sell the pair. Okay? At 5 o'clock, you will collect 3 days worth of interest. And then 5 seconds later, at 5:05 p.m., you close the trade at break even. But you got paid for holding it for 3 days. Why is that? Well, there's something that happens in the background inside the interbanking system where they call it a T+2. And you hear about T+2 and all this settlement type lingo. You hear more about that sort of when you trade stock. Okay? When you're trading stock, there's like, when can you close this position out? And you're like, oh, it's T+2, T+3, all this kind of stuff, right? So it actually, it's T+3. So anyways, so at 5 p.m. on Wednesday, you get paid for Saturday, Sunday, and technically, even though you held it on Wednesday at 5 p.m., you're actually getting paid for Monday. That's the weird thing. So if it's Monday and you're on a trade at rollover, you're actually getting paid for Friday or Thursday maybe. I don't know. It's the T+3. You're not actually getting paid for the day you're holding it. You're getting paid for the past. But very confusing, but that's how it goes. Now check this out. Monday is a holiday and banks are closed. So now on Thursday at 4:59, you sell the Mexican peso or whatever currency pair. And we're talking about carries, right? So at 4:59 p.m., you sell the peso on Thursday. At 5 o'clock, you get paid rollover. But Monday was a holiday. That's why we're on Thursday. So now you get paid for holding the position Saturday, Sunday, Monday, and Tuesday. You get 4 days. What? And then 5 seconds later, you close it out. So you've held the trade for 5 seconds and get paid 4 days of interest rates when the annual yield is 900%. Now, the trick is you got to cover your spread, and hopefully the market's not going up because you need it to go down. Okay? All right, Tova, you need to take the fundamentals course. Sorry, bro. I can't give you, I can't give you 15 hours worth of lecture on why that happens. You just need to take the course. So fxbootcamp.com, click on fundamental trading course. Yeah. Or if you don't have that kind of money, because you got to have money. If you don't have any money, go to a bookstore and buy a used textbook from 20 years ago on economics. That's the other way of doing it. They won't specifically tell you why the yen and CAD, why the yens move, but you still need to know the economic side of it. Cool. Hey, thank you for subscribing, guys. Seriously, it seems like a lot of people have subscribed. Right on. Thank you. I appreciate it. Welcome to the family. So let's go through some dollar pairs. Let's go through some dollar pairs. Well, no, I take it back. Let's do gold and oil. Let's do that. I was just thinking of an example, Tova. Hey, Tova, what happens if the U.S. economy tanks and you think you're going to lose your job, and so you decide to sell your house before housing prices collapse too? Because if you lose your job, you're not going to be able to pay your mortgage. Makes sense, right? So you sell your house. Thank goodness. You sold it at the top of the market. Thank goodness. Now, what's the first thing you do when that check cashes in your bank? What's the first thing you do? You dump the house, ownership's been transferred, money goes to your account. What's the very, 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 very first thing you do with that money? You pay back your loan. Remember, I said you have a mortgage. You pay off your mortgage. Okay? You pay back your mortgage. Yeah, cleared your loans. So I'm going to give you a hint. That's why the yen gets strong. Sadil says, hey, Wayne, are CAD Swissy and CAD Yen correlated? Yeah, I would think so, but I don't have the stats. But yeah, I would say there's a high positive correlation for sure. Is it 0.83 or 0.73? That I don't know. Okay. So hopefully that helps, guys. But, if you need help with fundamentals, take the fundamentals course. That's why I did it. All right, so let's go. By the way, I'm not likely to do it today, but probably tomorrow or Wednesday, I'm going to send out an email about joining the swing trading group, and our first meeting is on Friday. No, it's not a lot of. I know it's not a lot of warning, but you actually knew 6 months ago that this week would be the week we start. So you should already know if you're in the swing trading group. If you want to join, I'm sure you have a credit card or money, but I'm going to send out an email like, hey, we're starting, sign up. Like, there's no sales pitch. If you want to be in the swing trading group, the only prereq is that you have to take the swing trading course. But I'm thinking about testing out a new website to host our swing trading group. So I might just put the swing trading course inside that and include it. So in that case, you just sign up. But, you know, so be ready. I'll probably send something out. My realistic guess is I'll send something out Wednesday. You'll sign up on Wednesday, and we'll start trading on Friday. And I'll probably, yeah, so anyways, there you go. Well, actually, I might change it. The first one we may start on a Friday, but one of the things I'm thinking about in the future is doing the swing trading group on Thursday, because usually I can plan my trades. I can plan Monday's trades on Thursdays. And it also helps us out with things like when I do non-farm payrolls the first Friday of the month, that messes up our swing trading group and all that kind of stuff. And so I don't know. We may switch to a Thursday. Okay, but we'll see. But even then, yeah, I do record them. And they're going to be on Zoom, not the other one, so the quality is going to be better and all that kind of stuff. So just a heads up on that for everyone that wants to do live trading. But the idea is on a Thursday, let's say, we'll plan trades for Monday. And the trades will yield somewhere between 100 and 300 pips. And you'll be in the trade somewhere between 3 and 5 days, sometimes 3 to 5 weeks, but generally 3 to 5 days. All right, let's do some analysis here. I want to mark this up a little bit. So you'll notice I always leave notes for myself. So I say, hey, Wayne, like in the future, I'll say, hey, Wayne, did you see this? Okay. All right, so it really comes down to, are you a bull or a bear? Bulls are going to find this price here attractive. Okay, and they're going to find this price attractive. The problem is it's not an uptrend. There's a difference between buying like this and not buying like this. So, like the biggest question is, if you don't buy during this type of market, what market do you buy? Right? And these are big questions. But I'll tell you, just sort of generically speaking, this is the price bulls buy. This is the price that bears sell. You should know that factually. You should know that like you can say your ABCs and tie your shoelaces. And if you don't know what I'm talking about, you don't know how to tie your shoelaces or do the ABCs when it comes to Forex. If you don't know that, it's mind-boggling, right? So at some point, you'll need to take the swing trading course and get into the swing trading group. Because if you can't do that, how could you possibly day trade, right? And if you don't know your support, your leading support and resistance indicators, like how could you scalp with any consistency? Like I just doubt you could do any of it. Really, I'm very serious. I'm not being facetious. It's like if you don't know how to identify support and resistance using leading indicators, how can you be successful as a trader? Probably can't, right? But anyways, what was kind of needed here is we need to climb out if this is going to turn. Moving averages, yeah, but the problem with that pure mathematics is scalping has to rely on leading indicators. Okay? It just has to. if you're waiting for a moving average crossover, price is already down here. Like, especially on trades like, let's say you're making 25 pips or less, and most scalpers make half that. By the time you get your moving average crossover, you're already 9 pips away. Plus the spread. So like, you got to get 12 pips to break even, so to speak, because of this lag. You're lucky if it moves 25 pips, you're lucky to get 12 pips profit. But of course, luck is never on your side, right? So it's like, if you scalp and all you have is moving averages, as you suggest, by definition, you're slow. But how could you possibly be a slow scalper? Right? You know what I mean? Like, you can't be a slow scalper. Like, that's like saying jumbo shrimp. They're oxymorons. I'm a slow scalper. You're like, what are you talking about? Scalping's about fast, right? So by definition, by saying I'm a scalper or I like scalping, you must be quick. And therefore, maybe moving averages are helpful in certain ways, right? And you probably didn't mean like crossovers, which is fine. Okay, we don't need to argue that. They are helpful, but there's so much more important things going on. But you might say, like, so I'll agree with you now, pure mathematics. You could say on the 4-hour chart, I am going to scalp the 4-hour 21. And then when you're near that 4-hour 21, you drop into the 1 minute. So on the 1 minute, are you actually trading that 4-hour 21? No, that was the basis of your strategy. But really, true scalpers don't have strategy. So that's why I got to be careful with the language, right? So I totally disagree with you, pure mathematics, but I do. But under certain circumstances, what you said is actually valid as well. So yes, you could say, okay, I'm selling off the 4-hour 21, or I'm selling off the 1 hour 55 or something, or I'm selling off the hourly 200. Okay, great, right? But like, there's a danger to that. So what I say with the 200 EMA is it's a target, not an entry. So I don't actually trade off the 1 hour, 4-hour, or daily 200 EMA because it's fair market value. So all of a sudden, like, if you're going to use moving averages to scalp, you need to be a very skilled moving average trader to know things like you don't sell off the 200 no matter what. You trade to it, but you never trade away from it. Why? Because you know that that's the fair market value. You're in the neutral zone, and it's 50% likely to go up, 50% likely to go down, and that's a pathetic scalp. I would never trade with 50-50 odds. I want for sure money, right? So you have to know like the difference of that. But could I scalp off of 4-hour 21? Yeah, but then not on the 4-hour 21. That's a strategic move. And again, most scalpers don't have that kind of strategy, but I do. And I would say, okay, 4H21 is right here, so I'm looking to get short. Done. Strategy is done. Now I drop into the 1 minute, and do I need moving averages now? No, I'll take price action. Okay, I'll take price action. I don't need the moving averages anymore. So on this time frame now, I would be even like, let that kick in. Okay, this is what I need now. Okay, that's what I need. And so you might have meant sell off the 4-hour 21. I said, okay, that's cool. I'm on that. And this up here, I would count this as this was or is the 4-hour 21. Because remember, this can move up and down for 4 hours. That's still the 4-hour 21 because the 4-hour, you know what I mean, doesn't move except once for 4 hours, right? So for 4 hours, that is the 4-hour 21. And if I'm a bear, now I'm a seller, right? But now I'm pure tactics. So what do I do now? I only sell. I cannot buy. I still have to identify support and resistance, but I'm going to use pivot points, daily, weekly, monthly. I'm going to use price action. That's all I need, right? So let's say I'm a bear, right? Down, 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 up, up, sell. Down, 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 up, sell. Down, 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 up, sell. And if it breaches lower, down, 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 up, sell. What am I going to do after that? Down, 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 so on and so forth. And that's scalping off of a 4-hour 21. But is it really a 4-hour 21? Or is it just the basis of a strategy to say, I'm now bearish at this time, at this moment, at this price, everything lower, I'm taking south, and I'm going to use price action. But price action doesn't use moving averages, right? So that's why I'm like, I 100% disagree, except for that one sort of caveat. And then if that one caveat leads to a few buts too, like, but you don't trade off of 200, but you could trade off of a 21. Okay, that kind of stuff. But all of that is strategic, and then of course most scalpers have no strategy. And so what most scalpers are trying to do is, I don't know, sell, buy, sell. But I've analyzed so many traders, it's ridiculous. And what happens is they make a few good trades here, then they give some back, and then they make a few good trades here and give some back. And at the end of, let's say, 1 year of looking at this, they've made nothing. But they've spent 2,831 hours trading that year. Yeah, Carlos says he's seen scalpers buy and sell into spikes, which is just really, that's part of the get rich quick stuff. And really it's degenerate gambling. And typically it's poor people that do that because they have nothing to lose. I've never seen like wealthy people, they don't even think that way. They just don't think that way. Wealthy people have money and they have time, and they understand that their money is supposed to work for them like an employee. Poor people don't think that way. So they want to get rich quick. They got to get rich now, and they don't have much, so they're willing to risk it all and to make that almighty dollar and to sell into a giant green candle. It's very appealing when someone says, look, I made $700 in less than 20 minutes trading Forex with this new, sell into spike strategy. And it's really a horrible, horrible, horrible disservice to people. I'd rather say Forex is like a business. It's going to take investment. It's going to take a hard work, right? But you have to have a plan and a strategy, not just for running your restaurant or your car wash or your real estate business, but you actually need a business plan as well. How much money in, how much money out, what are your expenses, what are your flows, how much are you saving, how much do you need for your kids, how much do you need for your health care and your rainy day, and this and that and the other thing. And you plan it all out and you reverse engineer it. And hey, this will only take 10 or 12 years of really hard work and dedication. But by then, this should be a well-oiled machine. And you can't think any other way. You just can't think any other way. Because it doesn't exist. Like I said, it's a fool's errand to think about getting rich quick. Unless you're a drug dealer or a stripper, there's no way to get rich quick. I've never met one. Right? I've never met one. Never met one. I don't even know what that is, Eddie. So anyways, you want to run away from the idea. The message I try to give you guys every day is I want you to fall in love with doing the work, because you're going to be doing this for the rest of your life. And the first part is to love it, but also that leads to such a knowledge of this domain that when others with money have a need for a knowledgeable, experienced money person like yourself, you'll come across as someone absolutely amazing. And it's going to be your love and your passion for what you do, and that you have a long-term, risk-averse, methodical point of view. And you don't get caught up in the headlines and the excitement and the rah-rah speeches and, oh, what about this? And what about this? And, oh, what about that? You're just so above all of that you can sit down and logically explain risks and rewards with your clients. And they'll say, thank you so much for helping me through this very complicated situation. And I'll say, well, that's why you're paying me 20% of the profits and 2% management fee. I'm going to take care of this day and night, and I won't deviate. I won't be a degenerate gambler. I will not take undue risks. And I'm proud of taking losses if I'm wrong. But they'll be small. And I'm not wrong that much. So sleep well, my friend. Wire that 200 million and we'll get going. That's where you want to be. And why? Because you love the work, not because you're trying to get rich quick. No. Because you love the work and you want to do more work. Right? All right. So anyways, there's the buying price, there's the selling price. So it comes down to this week. If you're a bear, this is what you're thinking. If you're a bull, this is what you need. Okay? Done. That's how long it takes me. Done. Got it? Was that... Hey, give me some feedback, guys. There's 192 people here in the room. So there's quite a few new subscribers and stuff. So is that too esoteric? Was that too high level? Is anyone freaking out like, dude, just show me how to trade the euro dollar and shut your yap on all this fundamentals and trader psychology? And like, is it El Waymo? Was it Mucho Asamero? I don't know. Is it? Because I don't know. Some of you guys, especially lots of new people, and new people, please leave a comment here. I don't know the other YouTube channels and stuff. Maybe I'm supposed to F-bomb every third word and run through the charts really quickly and whoa, let's go F-bomb this and let's talk about that. Or I'm trying to explain how to do it right. Technically, psychologically, fundamentally. So we've covered a lot today. Okay. Lots and lots of new people. So please leave the feedback, okay? Or if you're watching a recording, would you please leave a comment? and just say, hey, that's way too esoteric, or hey, that was awesome, or I have no idea what you just said, but I feel bubbly inside. Like, yeah. Oh, it's on the download page. Max says, where are the vids that explain how to install it? It's on the download page. You know, there's the video right above the big button that says download your files here. There's a video right above it. I think it's on autoplay, but you might have to click the play button. Okay. Cool, great. Okay. Right on, guys. Thank you very much for subscribing. I look forward to seeing you guys tomorrow. I've been going an hour and a half. That's probably too long. Yeah, the stock market's open and stuff now, so yeah, I've got to roll. Right. So, anyways, thank you very much for being on my team every day and the loyalty and respect you show me and the others in our community. Please open an account at Trader's Way. And I will see you tomorrow. Thank you for being here at the Forex.Today YouTube channel. If you're watching a video recording of today's webinar, please leave a comment, okay? Tell me what you like, what you hate, what you learned, what you didn't learn, what you want to learn. Just tell me. So peace on earth. May the pips be with you. May your profits be above average. And I will see you tomorrow. There's another 4,000 videos associated with my work on YouTube. Feel free to watch every single one of them for free. Cheers, mate. I gotta go. It was real.